Today, we're going to get into one of the most important aspects of due diligence. Every time I'm under due diligence, the first thing that I do is I take a look at the rent roll. Now, if you don't know what a rent roll is, it's one of those sheets that gives you a detailed look at every single tenant in your property. It's going to highlight what units they're taking up, what amount of space they're taking up, their amount of rent. It can be a dollar amount or a dollar per square foot. It's going to tell you when their lease started and when it expires and if it has any renewal options within their lease. It's kind of like a summary for the property. And whether you're a newbie or a pro, this episode is going to help you sharpen your skills and avoid any costly mistakes. So I want you to grab a coffee, bourbon, tequila, whatever, get comfortable, and we're going to break down the rent rolls. So when we're looking at the basic rent roll, this is like your cheat sheet for understanding the income stream of a property. Once again, this is where I start my analysis every damn time. We're talking about the tenant specifics, their yearly rents, their space sizes. Sometimes it could have the configurations, their durations of their lease. Essentially all the juicy details that's going to tell you what kind of income you can expect from the property. So when we're looking at the rent rolls, what exactly are we going to be looking for? First off, we're going to be looking at trends. Do all of the leases expire around the same time, or are they staggered? Ideally, they'd be staggered because if every lease expires at the same time, you're probably going to have 100% vacancy when the expiration date comes up. So speaking of expiration dates, when does the lease expire? Is it coming up soon, or do you have some breathing room in there? Is it 5 years out? Is it 10 years out? Whatever. Keep an eye on those. It's huge because if you have a ton of leases expiring at once, it's going to be a big headache for you to fill all of those spaces if your tenants decide to bounce. And we like staggered expirations because they're going to give you more stability. If one tenant is expiring in 1 year and your tenant 2 expires in 4 years and another tenant expires in 10 years, when they do expire, if they don't exercise their lease renewals, it gives you time to lease up those units. And while they're vacant, you're still producing some income from the rents from the other tenants. Now, next up, when you're looking at the rent roll, I want you to always have the words value add in your mind. Is there any potential from the tenant perspective or the tenant mix perspective that you can do in order to add some value to the property? Can you bump up the rents? Can you fill up some vacancies to boost up your income? What type of tenants are they? Do you have anchor tenants? Do you have, major players that are holding down the fort? If you have upcoming vacancies, can you realistically fill those spaces? And knowing the sizes of your spaces is key too. The smaller units that you have, they're usually easier to rent out. But if you have some big box spaces, it could be a pain in the ass if they go vacant because your tenant pool for larger sizes are smaller than tenant pools that are occupying smaller spaces. And plus, your commissions for some of those spaces are going to be a lot larger. Now, let's talk a little bit about the rent rates. If you're looking at it from a dollar per square foot perspective, is that rent rate in line with the market, or are there any outliers within the rent roll? You want to compare the rent rates on your rent roll with the market averages. If your rents are above market, you got to figure out why. Is it because some sweet lease clauses are in there, or did the landlord just get lucky? Sometimes tenant improvement or TI costs are baked into the lease rates. So you got to make sure you're accounting for all of that. And here's an example. So if you have tenant A paying $10 a square foot for 10,000 square feet, but the market rate, let's say it's $8 per square foot, you're looking at potentially losing $20,000 in gross rents if that tenant does not renew. Now, if we look at it at an 8 cap, that's going to be a $250,000 hit in valuation. $250,000 gone, just like that. So above market rent can be a red flag unless there's a damn good reason for it. Now, next on the checklist, tenants with leases that are nearing their expiration date. Figure out when those leases started and how long have they been there. Are they likely to stick around? If they've been there for 30 years, chances are they're probably going to stay. But you never know. You want to double check all that information. Now, you also want to check if they have any renewal options and how much time they have left on their leases. This is where the WALT, or WALT, which stands for the weighted average lease term, comes in. It essentially is going to average out all of the remaining lease terms, giving you a sense of how much longer you have before needing to hustle for new tenants. And while you're in due diligence, don't forget about that vacancy rate that you found previously. You got to compare it to the industry benchmarks from brokers or even property management firms. You want to make sure that your square footage on the rent roll matches up with the offering memorandum. It sounds basic, but you'd be surprised how often there are discrepancies. And now let's not forget about the numbers, right? Rent rolls usually show the rent rate in any TICAM. TICAM is TICAM, which stands for taxes, insurance, and CAM that those tenants are responsible for. You add up those rent rates and you want to compare them to the gross revenue that's reported in the income statements. If there's a close match, fucking great. But more often than not, you're going to find some type of discrepancies. Jot those down, make note of them, and then ask either the broker or the owner thereafter to have them clarify that. Maybe it could be a clerical error, or maybe there's something more serious going on. Either way, you want to get to the bottom of it before you sign anything. Now, throughout the entire process, you got to stay on your A game. You got to look for reasons not to buy the property. I know it sounds counterintuitive, but trust me, it's better to find the skeletons in the closet now rather than after you've signed the dotted line. You want to document any uncertainties or inconsistencies and create a list of questions that you can bring up to the listing broker or the property owner, because you're about to take over this property, so you damn well better know what the numbers mean. And there you have it, people. That's a crash course on rent roll reviews. Remember, the more thorough that you are in your analysis, the better prepared you're going to be to make smart investment decisions. Thanks for hanging out with me today, and I'll catch you guys again next week.